It is Monday, July 28th, 2025. I've got David Blake with me. My name is Rachel, and we are here for a tech talk from MarketEdge.com. David, why don't you tell us about what the market did last week and what that points to for the market going forward?
Sure. Let's take a look. We had another really good week last week. We had the S&P 500, NYSE, the NASDAQ, and NASDAQ 100 all recorded new all-time highs, which is pretty strong. A broad-based rally here. The market started off a little slow last week. Then we got an announcement that the U.S. and Japan had completed a trade deal. It looked like it was pretty good for both sides, and the market really took off on that. The Dow Jones briefly crossed above 45,000. Everything was hitting new highs. Healthcare actually led the board higher. It was up 3.25%. And I believe every single sector participated in the rally last week. That's very strong. Materials, industrial, REITs, and financial also outperformed, which is a little different groups leading instead of just the Mag 7 pushing the market to new highs. So last week during the rally, we had a broadening out of the different groups and sectors. We've been kind of relying on the Mag 7 stocks and the semis to push the indexes to new highs. But this time we had materials and industrial, REITs, and financial also outperform. That's what you want to see in a nice broad-based rally for the market. You don't want to just continue to see the same group pushing it to new highs. So that was good. Now, rates were pretty much unchanged. You had a little bit of easing on the longer end of the 10-year and a little tick higher on the 2-year. It landed at about 392. We'll go into what we're looking at rates here in just a little bit longer because we have some important things going on with the rates this week. Touching on last week a little bit, we had a lot of earnings came out. We had a little bit of most everything is coming in better than anticipated. A lot of that is because during the earlier quarter, they cut the estimates because of what everyone was afraid of with the tariffs and the trade deals. The bar has been set pretty low for earnings for the second quarter. And that's why you're seeing more than 80% of the companies beat the estimates. That's above normal. And that's the reason being that they cut the estimates because of the tariff deals and stuff. They didn't know how it was going to be affected. So anyway, at the end of the week, the major averages were up. The technical condition of the market remains positive. We're starting to see just a little bit of a breakdown in the technical indicators. Not something that says we're going down 5% or anything at the moment, but we are seeing a little bit of a slowing in the momentum index. We look at the 14-day RSI. It's improving, but it's still, kind of looks like it's getting a little bit toppy in there. MACD, it's still positive, but we're looking at the histograms, which is the little bars that you see underneath an MACD indicator. They're pretty much flat, which means your trend is still higher, but you don't have the same oomph behind the move. In other words, sometimes you get all the indicators pushing up to overbought levels, and we are a little bit overbought, but you're not getting that where every day you're overbought, despite the fact that the S&P 500 hit a new high every single day last week. Okay, we had a nice little bounce back in the transports this past week. It had snapped a 4-week win streak the prior week. We got back on the plus side. The Russell 2000 was higher. It also saw momentum slow, and its MACD actually changed to bearish as the period was ending. We saw the Philadelphia Semiconductor Index. It snapped an 8-week win streak, which is fine. The SOX index is something like 70-some%. It's had a spike off of the April lows, so you shouldn't be too worried about your semiconductor holdings. Today, is bouncing back. It's up 1.5%. I think you have NVIDIA today and also Broadcom hitting new all-time highs. So that's helping keeping the NASDAQ positive while you're in a little bit of a sell-off here in the Dow Jones to start the week now that we're getting in the afternoon. We did see the VIX inch lower, the lowest level since early February. Normally, that's telling you that the traders aren't real worried about a big pullback in here. However, it can also, when it gets much lower than where it is right now, you can have to worry about investors getting a little bit too complacent. When that happens, if they get sidetracked with news, they can overreact to the upside or the downside. So let's watch the VIX. You don't want to see it getting much lower than, pushing down towards 10 or anything like that. And I think we finished around 14 something. So that's nothing wrong with that. I did want to mention that the CTI, we did see it was down 2 notches from the prior week to a -3. I believe that it's going to stay negative for another couple of weeks. And that probably means, once in a while, I talk about the forward lines of demarcation. And we're not really starting to break those yet. I think the Dow today may begin to break some of those lines. If it does, then we're going to start to be able to come up with some downside targets for the indexes. I think there's enough the negative divergence is showing up in some of the different signals that we have. Looking a little bit toppy here for the different indexes. And I think the 18-week, which is the B cycle, is about 2 or 3 weeks from probably what will be a bottom. That's when we would expect the market weakness we see here over the next 3 to 5 weeks. I think probably bottom out before we can start getting a little push higher, maybe in the fall again. Sentiment index is still a little bit negative, but we did move a little bit closer to a neutral stance. It was -2 from a -3. Nothing much there. We did see the retail clients, according to AAII, they dipped below their historical average, which is 37.5%. They dipped down to about 34, 35%. And the NAAIM, that's pretty much the hedge funds and active investment managers. They're pretty much staying almost fully invested. They're up about 80. They're at about 80% exposure to indexes. That means they like what they see. They think there's some good upsides. The momentum index actually ticked higher up to a positive +6 because of strong breadth. We talk about the NYSE advanced decline line is a leading indicator of market direction. And last week we saw a new high in that on Wednesday. Now, normally you'll see that top out maybe 2 to 3 weeks or so before the market begins to follow it lower. Or on the other side, if it starts to tick up when the market's going down, that's when you can start to see positive divergence, and it will lead the market higher if you look at that. I did want to mention that one of the things that we have in this market letter at the very bottom, we talk about what's hot and what's not in the top performing ETF categories for that week. I think that's something that you may want to take a look at, just to give it a quick glance. As far as the industry groups go, if you come up to the top here, you can look up here and click on industries, go to the different industries, and we rank them. We have 30 of them that we've broken it down into right now by relative strength. And now we're starting to see metals and mining, healthcare products come in here, technology, hardware, industrial goods, retail, hospitality. And this is areas that are leading the market higher. Looking over here at the relative strength, this shows you that right now metals and mining has been on fire for several months. It's outperforming the S&P 500 by 16%. The healthcare products are leading the market by 14%. And if you click on that, you can go over here and get a list of different healthcare stocks. And if you go like this, which ones are the highest? So let's just go by power rating. If you get down here, you look at these, you want to look at something that's maybe in the 80s, 90s, as far as how they're moving to looking for some new buys. In this case, you can see that when we talked a couple of weeks ago, you don't want to be buying something that's up 20-some%. If you look at it over the last 10 days, a lot of these healthcare product stocks are up 20-25%. And that's why you saw the whole sector, which has been lagging the broader market, have a really nice rebound last week, being up 3.5%. So this would be an idea that you can look at in these industry groups. Again, you want to have your money in the strongest areas of the market. You can buy a great stock, but if you're in a weak industry group, like insurance or paper and forest products right now, I don't care what you're buying. If it's a great company, you're still going to underperform the market, and that's not what you're here to do. You want to try to be at the top of the market. Okay, we do a little bit different thing here with ETFs. What I do is the relative strength is over 50 days with the industry groups. I also try to do on the ETFs is we do this by 1 week. So we want to make sure that sometimes this will catch a group that's just starting to take off. Last week, over 1 week, the sector was up 3.5%. And here the specialty health group ETF was up 3.4%. So the healthcare stocks, to me, look like they are really starting to move. Over here, you can see when you put your cursor over specialty health, you can see it's been an extended downtrend, and now it's just starting to move up off the bottom. Has really underperformed the S&P 500, which is the green line there. So this is an area that over the last 30, 40 days and last week, it's really been outperforming. So this might be an area where you can look at some places to buy. You're still underperforming the S&P 500 over the last 50 days. So this is somewhere that you can find some ideas. If you don't want to buy individual stocks, you can go in here and buy the whole sector, which means it's not going to be as volatile in your portfolio. If you're a little bit older and you don't want to see your portfolio get blown up with a single stock that gets smashed, you buy the ETF and you're holding 20 stocks. If one falls out of bed, it's not going to hurt you too bad. So that's some things that you want to look at. Real briefly, what we're going to look at this week, because this is probably one of the busiest weeks and most important weeks of the year so far. Number one, we have tomorrow, we get the FOMC meeting begins. And on Wednesday, we get Fed Chair Powell will give his press conference at 2:30. They're going to make the announcement on interest rates at 2 o'clock. And there's only about a 2% probability that they're going to cut rates. And again, with the deals we have going today with the European Union signing a deal here, we have China in there talking. Some of these things still have tariffs involved, which could still be inflationary. So you're not going to get anything going tomorrow, but the market wants to hear that you have a few Fed officials saying that they would not be opposed to a rate cut in July, this week, but it's not going to happen. But you do want to hear a little bit of a dovish response from the Fed chair when he comes out on Wednesday afternoon. Now, also this week, we have the busiest week of earnings releases over here. We've got some of the Magnificent Seven. And then also Wednesday, we have the ADP employment report. That's been a little bit soft lately, and they've been kind of pushing that off a little bit to the side. But on Friday, we had the Bureau of Labor Statistics will come out with July jobs. And right now, they're looking somewhere around 106,000. There was a surprise to the upside in June when it came in with 147 new jobs. So they expect to see it fall back. They may see the unemployment rate tick up to maybe 4.2 from 4.1. Not a big deal, but the Fed is paying attention to the job market. They don't want to see the jobs market soften too much. So a lot of stuff going on. I would expect a volatile week. But again, with all this stuff going on and all the negative divergences that we're starting to see in some of the different indicators, I think the market's looking a little bit toppy. It would not surprise me to see us start to roll over towards the end of the week here as we start to sell the news with all the announcements coming out this week. So this isn't a time to be chasing things. Just we had a good week last week. I would just kind of maybe hold on to what you have, maybe look at starting to take some defensive action with some of your larger holdings and see how the news rolls out this week.
Okay, so on the weekly comment down, sort of buried beneath the commentary, we have these strength indexes. We have a ton of numbers here. Can you give us some context on how to use these numbers?
Yeah, strength indexes are kind of accumulation, a distribution type of thing. It's not so much the percentage numbers. What's important is the slope. In this case, you have a drop from 74 down to 34. All three of them went down, which means you're starting to see in the group of stocks that are covered in that. When we say the NYSE is making a new high in the AD line, which is really important, a leading indicator, these are just a smaller grouping of stocks like the Dow Jones, the NASDAQ 100, and the S&P 100. So instead of looking at 2,500 stocks, it's looking at a smaller group. With the smaller group, you can take the slope of its own AD line, which is the strength index. If the slope is starting to turn down, then you can look at how that's going to we're starting to see some negative divergence. Again, Dow Jones and the NASDAQ 100 are both still positive in their percentages. The majority of the stocks are still going up. However, there's still a slope that pointed down, which means you have some weakening in some of the underlying issues in that index. And that is important. It just kind of gives you a negative or positive divergence of what might be happening. In other words, sometimes you'll see the Dow Jones lower, and then all of a sudden you see, but then you had the S&P 500 NASDAQ making new highs. That's because the Dow Jones had 30 stocks. And at that time, I know that UNH, United Healthcare, was a big problem with that and some of the other ones. So if you look at those, again, you're always looking, especially when you've had a nice run in the market or a big sell-off, you always want to be looking at some of the indicators, not to be catching a bottom or catching a top. What you're looking for is negative or positive divergences. In this case, as we're getting to a top, we're starting to see some weakness showing up. But this is another factor that you can look at it and say, okay, the underlying issues in the Dow and NASDAQ 100 are beginning to show negative divergence. There's less of them going up as that index is making a new high. And again, you're collecting these positive and negative divergences so that you can begin to think, okay, it's toppy, and I want to start to position myself. Maybe I'm going to lighten up. I don't want to be on margin for sure. And on the other side, once you start to see some of the strength indexes and other things that we talk about starting to move up as the market's still going flat to down, that's when you start going, okay, I like this. I think we've hit a bottom in here. And this will give you a heads up that you want to start thinking about that the market's about to turn. This would be a good example.
All right. Anything else to cover today?
Yeah, that's going to do it for the week.
Very good. Well, thank you for your time today, and we'll chat next week.
Okay, have a good one.
All right. You too. Bye.